They set the trap, changed rules mid-game, engineered a 38% crash using the worst nomination and repeated margin hikes, expecting panic, capitulation, and retail surrender. They expected retail investors to sell the bottom while institutions accumulated cheap metal. But the plan spectacularly backfired as markets refused to collapse under engineered pressure. Instead of a collapse, gold shattered the 5,100 barrier, and silver surged back toward 85, proving resilience and exposing the failure of coordinated suppression attempts. The smart money did not sell the dip. They bought aggressively, recognizing structural demand and exploiting forced liquidations created by margin hikes and panic-driven retail exits. Institutions that shorted silver into the crash, betting on continued weakness and retail panic, are now trapped in a margin call feedback loop with days remaining. With only 6 days until the February 27th delivery deadline, the pressure intensifies as rising prices, margin calls, and insufficient physical supply converge into a crisis. My team spent the entire weekend analyzing raw exchange data, uncovering numbers that confirm a historic short squeeze has already begun within the silver market. In this analysis, I will show why institutional shorts are trapped between rising prices, escalating margin requirements, and a delivery deadline lacking sufficient physical metal. We will examine the mathematics of 88.79 million ounces of registered silver inventory against 429 million ounces of March open interest. I will explain what happens in 6 days when first notice day forces the paper market to prove it actually possesses the physical metal backing contracts. Before breaking down the data, we are building a mastermind community of critical thinkers, not passive viewers, encouraging debate, analysis, and collaborative reasoning in the comments. I will be actively reading and replying to your thoughts today, encouraging you to engage with each other's logic and challenge assumptions through respectful, analytical debate. With 6 days left, registered inventory falling daily against massive open interest, will banks survive, find emergency supply, or face historic default under impossible mathematical constraints? Comment survive, or default below, and explain your reasoning, considering cash settlement, emergency sourcing, or whether the delivery math simply cannot be reconciled in time. Pause the video, share your thesis, and let us examine the hard numbers defining the next 6 days and the potential transformation of global precious metals markets. Weekend closing data reveals who is winning this battle, with price action signaling strong demand, institutional repositioning, and growing divergence between paper pricing and physical scarcity. Gold closed Friday above $5,000, getting over $60 in 1 day, decisively breaking psychological resistance and pressing critical levels near 5,100. Wall Street bears retreated as gold surged, recovering hundreds of dollars from correction lows, signaling renewed safe haven demand amid geopolitical tensions and systemic financial uncertainty. Escalating geopolitical tensions and nuclear ultimatum rhetoric injected urgency into safe haven positioning, decoupling gold from traditional inverse dollar relationships and signaling systemic fear-driven demand. Gold rising, despite dollar strength, confirms this movement reflects structural fear, physical demand, and institutional repositioning rather than simple currency devaluation or speculative trading dynamics. Goldman Sachs reaffirmed its $5,400 gold target, citing sustained central bank demand exceeding 1,200 tons annually for 3 consecutive years. This demand is institutional, strategic, and persistent, reflecting global monetary shifts as central banks diversify reserves away from fiat currencies toward tangible stores of value. Now silver, where squeeze mechanics become undeniable, closed near $80 with strong daily gains, confirming continued recovery from the engineered crash and renewed physical demand. March futures touched mid-80 levels intraday, reinforcing bullish momentum and suggesting consolidation before potential breakout toward higher resistance levels driven by structural supply deficits. Understanding the V-shaped recovery explains why shorts are trapped, beginning with January's record highs followed by the engineered crash and rapid institutional accumulation at distressed prices. January 30th marked the worst one-day decline since 1980, accelerated by margin hikes that forced liquidations and created an automatic unwinding machine for leveraged positions. At the exact bottom, major institutions reportedly stood for delivery of millions of ounces, converting the crash into an inventory acquisition opportunity at artificially depressed prices. Silver rebounded sharply through February, establishing a strong floor near 64 as industrial buyers re-entered markets to secure supply amid tightening global availability. The crash flushed leveraged speculators, while physical demand from solar, electric vehicles, electronics, and infrastructure created an unbreakable bid supporting prices during recovery. Silver now consolidates between $70 and $84, with a breakout above 84 increasing probability of retesting triple-digit levels, driven by structural deficits and squeeze dynamics. Rising prices create a self-reinforcing feedback loop, trapping institutional shorts. As losses mount, margin requirements increase, and forced covering accelerates upward price pressure. Institutions that shorted between 64 and 75 are underwater, facing escalating margin demands as percentage-based requirements increase automatically alongside rising silver prices. This dual squeeze forces short sellers to post additional capital, while rising margins increase position costs, amplifying pressure on leveraged participants and accelerating forced liquidations. When traders cannot meet margin calls, brokers liquidate positions, forcing shorts to buy silver to close positions, creating new demand and further upward price momentum. This feedback loop repeats as rising prices trigger losses, margin calls, forced covering, and additional demand, compressing supply and intensifying pressure on remaining short positions. Physical supply constraints worsen the squeeze, as shorts cannot source metal easily, forcing competitive bidding in increasingly illiquid markets with tightening global inventories. The squeeze converges with a delivery deadline, forcing shorts to buy metal, roll contracts at premiums, or risk default amid dwindling physical availability. Elevated lease rates and regional price premiums confirm extreme tightness, with lenders demanding significant premiums to supply physical silver amid global scarcity signals. High lease rates historically indicate severe supply constraints, reinforcing evidence that physical shortages are intensifying despite relatively modest paper market pricing levels. Now, consider the inventory data forming a doomsday clock, showing rapid depletion of registered silver inventories and growing mismatch between deliverable supply and open interest obligations. Registered inventory declined dramatically from October levels, breaching psychological thresholds and continuing daily withdrawals that project dangerously low levels by delivery deadlines. At current depletion rates, inventories may fall further by first notice day, intensifying delivery stress and increasing likelihood of cash settlements or emergency exchange interventions. Open interest far exceeds registered supply, creating delivery scenarios where even modest delivery demands surpass available inventory, highlighting structural vulnerabilities within exchange settlement mechanisms. If 25% demand delivery, required ounces, exceed registered supply, demonstrating the fragile balance between paper claims and physical availability within current market structures. Higher delivery rates amplify shortages, potentially requiring multiples of registered inventory and exposing systemic leverage embedded within futures markets reliant on contract rollovers. Recent delivery trends show investors increasingly demanding physical metal rather than rolling contracts, signaling declining confidence in paper settlement mechanisms and growing preference for tangible ownership. First notice day forces a decision: roll forward, accept cash settlement, or demand delivery, placing institutions with short positions into a binary outcome under severe supply constraints. If exchanges cannot deliver and declare force majeure, it would confirm paper leverage exceeds physical backing, triggering potential price decoupling between physical and futures markets. Shanghai benchmarks already trade at persistent premiums, reflecting regional supply constraints and logistical barriers, limiting arbitrage despite global pricing disparities. China controls significant refining capacity and implemented export controls, reinforcing national strategies to secure domestic supply and limit outbound flows amid tightening global markets. Major industrial consumers are bypassing exchanges through direct offtake agreements, signaling declining reliance on centralized pricing mechanisms and prioritizing supply chain security. Technology manufacturers securing long-term supply contracts demonstrate strategic positioning, effectively voting against paper markets and highlighting growing distrust of exchange-based availability. High-net-worth individuals and institutions are adjusting portfolios, recognizing that traditional allocations fail to hedge against currency debasement and structural shifts in global monetary systems. Precious metals increasingly serve as core allocations rather than insurance positions, reflecting paradigm shifts driven by inflation risks, geopolitical instability, and declining fiat currency confidence. Institutional strategies now include precious metals within resilient asset baskets, emphasizing their role in protecting wealth amid technological transformation and monetary uncertainty. Physically backed trusts are expanding acquisition programs, representing significant buying power relative to exchange inventories and further tightening available supply for delivery obligations. ETF flow divergence shows capital migrating from unallocated paper exposure toward physically backed vehicles, signaling institutional preference for direct bullion ownership over derivative claims. Global silver deficits persist monthly, with cumulative shortages reaching hundreds of millions of ounces, marking consecutive years of structural imbalance between supply and demand. Silver's role as an industrial necessity for solar panels, electronics, defense systems, and artificial intelligence infrastructure ensures deficits will reprice markets rather than resolve quietly. Understanding community positioning helps assess readiness, as institutions face margin calls while individuals must evaluate exposure to paper assets versus physical precious metals ownership. Comment paper or physical below, sharing allocation strategies, so the community can evaluate preparedness for potential wealth transfer driven by systemic market repricing. If heavily exposed to paper assets, explain your thesis. If positioned in physical metal, share allocation logic to foster collaborative learning and strategic insight. Wealth managers evaluate the next 6 days through risk-reward calculus, assessing consolidation ranges, breakout triggers, and extreme scenarios involving force majeure or full squeeze conditions. Breakouts above resistance increase probabilities of retesting prior highs, while ratio compression and structural deficits suggest potential price targets far exceeding current levels. Force majeure scenarios could trigger paper physical decoupling, with prices determined by physical availability rather than derivative markets unable to meet delivery obligations. Historically, the majority of bull market gains occur in final phases, suggesting the most explosive price movements may still lie ahead as structural pressures intensify. As of February 21st, gold consolidates above 5,000, silver recovers strongly, and registered inventories continue declining against massive open interest obligations. The engineered crash flushed leveraged speculators, but failed to break structural demand from industrial users, central banks, and physical accumulators driving long-term market support. Institutions that shorted into the crash are trapped between rising prices, escalating margin calls, and delivery deadlines lacking sufficient physical supply for settlement. The feedback loop is engaged, the clock is ticking, and only days remain before delivery obligations test whether paper markets can meet physical realities. Asian markets reopen soon, futures resume trading, and participants must decide strategies amid tightening supply, rising prices, and potential historic market transformations. Are you adding physical positions, holding through volatility, taking profits, or positioning for a breakout above resistance levels driven by structural supply shortages? Share your strategy and reasoning, including breakout buying, waiting for regional market signals, or monitoring emergency exchange rules that may alter settlement procedures. We learn by challenging assumptions and sharing insights, strengthening collective understanding as markets approach potentially historic inflection points within global precious metal systems. Subscribe and stay informed, because the coming week could rewrite financial history, with inventories critically low and institutional positions increasingly constrained by supply realities. 6 days remain until the deadline. The short squeeze is underway, inventories are shrinking, and institutions face mounting pressure as delivery obligations approach rapidly. This engineered crash backfired spectacularly. Shorts are trapped, the math is unforgiving, and the countdown toward potential market transformation continues relentlessly. I will see you in the comments as we analyze developments together, testing our theses and preparing for outcomes that could reshape precious metals markets permanently.